Welcome back, everyone, to Kyle's Financial News. My name is Kyle, and we have some news topics for you today. Today's date is May 23rd, 2024, and we've got a couple topics to go over. Nvidia's earnings are out. Some big bank regulation changes might be coming down the pipeline from the Fed in the following years. We'll talk about that. We're going to touch again one more time on mortgages, some new numbers out for that, and we'll do some discussion in and out of all those. So check it out. Hey, quick disclaimer. Any information that I provide in these videos is just for general information purposes only. It is not intended to be financial advice. I am not a financial advisor. Any opinions or statements that I make in these videos are just that of my own. They're not provided to me by any organization or entity. These are just my own opinions, my own takes. So please do your own research. Do not take any of this as financial advice. I am not responsible for any outcome, gains or losses by any decisions that you make based on what you watch or hear from my videos. So yesterday's discussion was about the post FOMC minutes release. Nothing really changed from the Fed's perspective, and we talked about that in yesterday's video. The market started to sell off decently well, about negative 0.5% on the S&P 500 going into the end of the session. So I was curious if Nvidia's earnings, there was a number of earnings yesterday, but Nvidia mainly being one of the bigger ones, would have an impact on that negative price action. And it sure did. Even though the indexes closed fairly negative for the end of the session, once Nvidia posted, it just whipsawed right back up. So we saw a rally into the Asian and the European market sessions. There was even some rally this morning in the US session. It wasn't until a couple hours into the session that indexes then rolled over and started to really decline. So we ended the day with the Dow down negative 1.5%, the S&P 500 down almost a whole percent. So there was some pretty strong selling that took place. Kind of makes you wonder if just that rally overnight was just bigger players taking positions or getting situated for the move that they then made later in the session today. So do you guys keep up with Nvidia, or do you monitor their progress on AI and their AI hardware? If you have any Nvidia stock, please let me know in the comments. I don't own any Nvidia stock. I have not ever purchased any Nvidia stock. Just throwing that out there. I'm not long or short, so I don't have a position in it. Another thing that I'm looking at that I find kind of interesting, Nvidia has made a 25x return on their market cap in the last 5 years. They are now sitting at $2.6 trillion of market cap, and they have just been knocking out place after place after place on the podium of these behemoth companies. So the next one really that's up there is Microsoft, sitting at $3.1 trillion. And I'll be honest, Nvidia just has so much momentum going with it right now. I would not be surprised if in the very near future we see Nvidia top Microsoft in that $3 trillion market cap category. So will it take over? We don't know for certain. It's something to potentially look forward to. But it does have a lot of momentum. Speaking of momentum, please consider subscribing. Even if you just leave a like or a comment, anything at all really helps. I'm brand new to YouTube, and I really like talking about finance and sharing some experience with y'all and going over the news and breaking events. I want to keep that momentum going. So please subscribe, like, hugely appreciated. One last thing on Nvidia. Sometimes these post splits, you just got to keep an eye out for that price action. Tesla, Amazon, Alphabet have all done splits in the recent years, and I'm not saying that it for sure will happen, but sometimes you will see a pretty significant sell-off in a company in the coming weeks, months after a split. So there may be some really good opportunity if you want Nvidia stock to buy in at a lower price. Maybe just keep some cash on the side. You never know. Let's move on to the Fed. The Fed and the FDIC are looking to loosen some regulations on banks. They want to allow the banks to hold less capital and less liquidity The FDIC is also considering reducing fees that banks pay into a insurance fund, basically, that is used to bail out, in a way, kind of self-bail out banks if they run into a liquidity crisis. So think of like Silicon Valley Bank, and there was a few other banks in that March of 2023 timeframe that started to really struggle. And it was just liquidity problems. They didn't have the money on hand to satisfy the customer demand and withdrawals and all that stuff. By not having a insurance fund to cover that type of potential problem, I don't think it's a great idea. Apparently, the Fed and the FDIC think otherwise. Even with the insurance fund that they had at that time when Silicon Valley Bank went under, the Fed still had to print, or at least re-add to their balance sheet, almost $400 billion of assets just to float that hiccup in their system. Now, they did immediately start releasing those assets from their balance sheet over the following months and year or so. But it just goes to show the potential impact and the seriousness of even just one relatively small bank failing. I mean, Silicon Valley was no multinational, not even national bank. You know, they had a couple of, I don't know how many brick and mortar places they were operating. I think it was only 12 or something along those lines, mainly in California. So, God forbid a bigger bank failed, and reducing the amount of liquidity and capital that these banks have to have on hand, and reducing the need for an insurance fund that these banks have to contribute to. Sure, their argument is that it might help promote lending and the economy growth and just the churning of all the regular stuff. But the risk, I just think the risk is very high, especially with the type of conditions that we're in, with interest rates still kind of being up in the air about whether we're going to raise them a little bit higher, whether we're going to raise them significantly higher, or if we're ready to start lowering them again. And all that is based on inflation, which we really don't have a good grip on yet either. It's still in the 3, borderline 4%, nowhere near the 2% that the Fed wants it at. So risky business. We will have to stay tuned on what they do there. Now, they were talking about making these changes over the coming years. So this isn't like this is something that's going to happen in the immediate future. So, and this doesn't even mean that it will happen at all. So we will just have to keep an eye on that. 30-year mortgages came in even lower than we were talking about on Tuesday. Tuesday, they were down from 7.08% to 7.02%. We are now under 7% at 6.94%. So mortgage rates are continuing to fall. I don't know if we will continue to see them to fall. I think they're going to kind of fluctuate a little bit throughout this high 6.8, 6.9, low 7.1, 7.2, at least until something changes with interest rates. So all that is fun stuff to keep an eye on. We will see if there's any big earning reports coming out today. No big news events for the rest of this week, so we will be looking at next week. Market is closed Monday, naturally being a federal holiday. And thank you for tuning in, and I will catch you all next time.